Good morning, everybody, and welcome to this month's webinar, IFRS webinar. And good morning to Kevin and Ashley.
Good morning, Aletta, and good morning, Ashley. Lovely to see you both.
Yes, good morning to you both.
So today's topic, accounting for convertible notes, is one of the most complex areas in accounting. And Kevin and Ashley will tell you that even when the technical experts deal with convertible notes, we check and we double check and we speak to other people. It really is a complex area. However, you would ask, why do we want to raise this on a client webinar today? And the whole purpose of this topic is to put it on your radar. We know that in a post-COVID world in particular, there's a lot of interesting types of financing transactions happening, and therefore convertible notes definitely flavor of the year in 2021. So we're seeing a lot of them. We know they're difficult, and we just want to put it on your radar that you don't fall over them, that you don't get tripped up, that you speak to us if you need any assistance. So as always, I've got Kevin from Sydney, Ashley from Perth, and the three of us will do a joint presentation. Before we go any further, I thought I wanted to flag our BDO Global publication on accounting for convertible notes. This publication has been recently updated because accounting for convertible notes are governed by IAS 32, but also the new IFRS 9. And also, we've seen so many new types of convertible notes being issued that it was really important for us to update this publication, and it was reissued better and improved last year. Now, there's some amazing stuff in this publication, and we'll refer to it quite a lot. So the link is there. You would have received the PowerPoint slides, the participant version of the slides this morning, and you would have also received a link to this publication, but if not, here it is again. And then after today's session, you will also receive the presenter version of the slides, which includes the solutions to a number of questions, in particular polling questions. So that's a little bit of an introduction to the session. I'm going to hand over to Kevin to introduce convertible notes and make a number of high-level comments. Then I'll look at a diagram, and Ashley will do a number of case studies. So Kevin, over to you.
Thank you, Aletta. And it's very dangerous handing over to me first, because now I can take as long as I want to and leave the end of the session to you to hurry up at the end. But I won't do that. I will provide some commentary on convertible notes. For those of you who follow me on LinkedIn, I did make a few comments in the lead up to today's session on this being the big session of the year, and Aletta is 100% correct. I would say this. It used to be in the top 3 of my frequency of questions, but it's probably now the #1 question we get since COVID hit. And not only COVID, it's also that there is a lot of money in the system, especially coming from the US, investing into projects, startups, or projects that are coming to the end of their development phase. And there's a lot of money in the system currently at play. And those investors, especially the US investors, private equity investors, and so forth, they often go looking for these types of instruments. And that's especially true in development or startup phase entities. And by their nature, convertible notes are generally negotiated as an instrument that gives the investor upside protection in the equity instrument, and downside protection in the form of being able to extract their cash out if they can, when things don't really sort of go their way. So we'll jump into the first slide on the deck. Why are we doing this session? Well, it really is because there's a lot of money sloshing around in the system, and the types of instruments that are being negotiated are generally convertible in nature. Now, I would like to make a comment that the accounting side of what we're doing today is actually what comes at the end of of these instruments, shall we say. So what will happen is the entity will go looking for money. Sometimes they're in dire need of money, so they're running around trying to find investors, and the accounting often gets left till the end. Now that is the number one error when you want to deal with convertible notes. Don't leave the accounting till the end, because once the documents like the investor deeds or the convertible note deeds or agreements are signed, you've locked the accounting in at that point. So very often with accounting instruments, the accounting is locked in during the negotiation phase. And I want to say that there's a liability and a derivative derivative liability, which we'll get into. Those issues are often directly linked to how desperate the entity is for money. Now, let me explain what I mean by that. During the negotiation phase, when an entity really needs cash, it leaves them vulnerable to the investors seeking more and more and more and more. What actually happens in that scenario is the investors will seek to extract as much value out in the negotiation, depending on the desperation of the entity. Those desperation type negotiations often mean that the entity gives the house away in the form of convertible notes. And what I mean by that is they give more and more to the potential investors just to get the cash. You're desperate for money. Your project is maybe in the final stages of reaching its development. You're almost into production of a new, fundamentally great idea, something that's a great new a new project that's given rise to a new concept that nobody else has. You're almost there. You've just need another year's worth of financing. The investor, who's your potential investor, knows that, and he knows that you're almost there, and he's just got to get you across the line financing. He's going to ask for more and more and more and more in the negotiations because the entity is desperate to get the funding. Those features, the ones that the investors are demanding as part of the negotiation, are often the problem from an accounting point of view. They are problematic in the sense that they lead to liabilities, and they are problematic in the sense that they lead to derivative type instruments. So that's really why we are doing this today, to talk about those types of instruments and those features. And I will say that in the negotiations, you should probably be aware that if that is happening, those are the features that are going to lead to the accounting problems down the line. Now, the two big issues, and I will skip over some of the detail yet today, but the two big issues are debt and equity. Those are the two big issues. And then later on, you'll see derivative liability features are also problematic. And the derivative liability features, which are really the problem. Why? Because not only do they end up as being liabilities on your balance sheet, they also end up being measured at fair value, and they need to be remeasured at each reporting date, which means not only do you need a valuation, which can be costly, but it also introduces volatility to earnings, because valuation changes to those derivative liability features are fair value adjustments up or down through profit and loss, and no one wants their EBITDA or profit to be impacted by unknown valuation adjustments every reporting period. So those are the two key features that, at least on a practical level, I think are problematic. There are tons more problems that can come from these types of instruments, but in my world, or my practical world, debt and derivative liability, those are the two things that tend to be the bigger problems along the way. So today we're going to talk about debt and equity. Debt and equity, and that classification is generally governed by IAS 32 or AASB 132 in the Australian vernacular, and that's really financial instruments and presentation. But of course, the measurement and the fair value adjustments are generally written by IFRS 9, the financial instrument standard, in terms of measurement and in terms of how those instruments are recorded both at initial recognition and subsequently, which I think is actually the next slide, Aletta. I think the next slide talks about debt and equity. Now, the big issue here is how to account for these. Now, I want to make a comment that there is this misconception in the industry, or in the profession, that all convertible notes really just are debt and equity. And that comes from, I think, it comes from the way we train accountants on convertible notes. So at university, and Letty, you'll bear me out, and Ashley, you'll bear me out, we teach the students that the only type of convertible note you can ever have is a preference share. And a preference share has debt and there's a bit of equity. And those, we call those compound instruments. And everybody thinks that at worst, that's the accounting. I want to say, and Aletta and Ashley, you can confirm by nodding your head or whatever, I haven't seen a preference share come across my desk in about 3 or 4 years. No one issues preference shares anymore. What they do is they issue convertible notes, and the convertible note is literally all the rights sit often in the hands of the holder of the instrument. So the investor that's giving the money, that's the holder. And essentially a lot of the decision making about whether these things actually convert are in their hands. And also a lot of the terms in terms of debt and equity classification sit in those holders' hands. I want to say that I almost lied. Last week, I saw something that had a little bit of equity. It was the first time I saw an instrument with a little bit of equity in a long time. Mostly, these things end up being all liability, and often with derivative liability features that are separate features that need to be separately valued and accounted for on the side, which we'll get to. But the big issue here is if you do get to these types of instruments, the way they are accounted for at initial recognition when the instrument is issued, the fair value of the liability is calculated first, and any residual, it goes to equity if there is equity. I'm not seeing a lot of equity in practice anymore. It's mostly all liability, and it's mostly all derivative liability. So that's the first issue. And as I've mentioned, if you do have a liability at the end, those need to be measured at fair value if it's a separate derivative feature, which we'll come to. But at a minimum, if you've got a liability, that means there's what we call a host debt instrument, which means you've got a loan with a bit of interest, and you've got other features like derivative features that have to be separately accounted for. The equity is generally the balancing figure at the start, at initial recognition, and you generally don't touch the equity after that again, but the liability requires all sorts of ongoing accounting, whether it be at an effective interest rate on the loan or derivative valuations on an ongoing basis. But like I've said, on the equity basis, I'm not really seeing many of those in practice, so probably won't spend much more time there today. Transaction costs, we're not going to get into that today in a large way, so I'll leave that to the side. But the transaction costs in issuing these instruments do need to be taken into account in measuring the initial instrument. I'll leave that to the side. You can phone me and we can do a consult on that on the side when you get to transactions. The next slide is just the extract of the definitions, which Aletta's bringing up there. Now, we've put that there because these are conceptually the important parts of deciding whether you have a liability, whether you have an equity instrument at the beginning, and also whether you have derivative features. But because we're such amazing accountants and we love you all to bits, we've gone and summarized this on the next slide, which is really where the key derivative definitions kind of pop out. So these are the sort of key principles that we're going to use for the rest of today's session. And I want to say that if you're doing a negotiation with an investor for a convertible note, you should probably keep these principles in mind so you can start to get an understanding of what the accounting is going to look like. The first question on the left is probably the most important one, well, arguably, and that is, does the entity that's going to issue the convertible notes have a contractual obligation to deliver cash that it cannot avoid? I've left a couple of words out there because the most important thing is, do you have to repay this? Now let's take a basic liability. If you get a loan from the bank, and let's say the loan from the bank is 3%, and you have to repay it, well, the reason why it's a liability is you have to repay it. You've got an obligation to repay the cash either at the end or during the period of the instrument, monthly repayments or quarterly repayments plus interest. Those are cash outflows that you cannot avoid because it's contractually agreed, and that means that's a financial liability. So that's the basic concept of any liability. Building up from that, a very vanilla type convertible note will be one where you either have to pay the cash back or issue shares to repay the obligation. And that's your basic convertible note. And that's the basic preference shares we always see when we do university studying is you've got your obligation to pay the cash back, maybe some interest, but you could also pay it back in shares. Well, that means you still have an obligation to settle. The question then is, do you have an obligation to settle in cash that you cannot avoid? And this is where the concept of obligations and rights, and the rights that exist in the hands of the holder and the issuer, start to become important. Most convertible notes that we see these days give the holder the right to decide whether they can get cash or shares. So if you take a sort of a vanilla convertible note, let's say it's a convertible note which at the end of the period, the holder can either decide if they take the shares or the cash. That's the plain vanilla scenario. And in that scenario, the entity cannot avoid paying cash if the holder requests the cash. So that means that if the holder has the right to decide whether to get cash or shares, the entity can't avoid cash if the holder chooses to take the cash. In that case, straight liability. I almost want to say there'll be no equity in that scenario, because at that point, the entity is obliged to repay the cash when the holder chooses cash. Pure liability, and I'd go as far as to saying you're going to have no equity in that scenario. It's just a basic settlement of a loan at that point. The holder gets to choose the equity, but actually the entity can't avoid the cash if the holder chooses. And that's what the first principle is all about. When you're looking at the accounting of these things, these instruments can be quite complex, a lot going on in them, but the basic principle is if under any scenario the entity can't avoid paying the cash, it's going to be a liability. There's almost no exception to that. Can't think of an exception. On the right hand side, if a contract may be settled, sorry, go back, sorry, later. If the contract may or will be settled in cash, in equity, this is where derivatives start to creep in. So also basic scenario, yeah, you've got a liability and the holder, let's say, has a right to shares. The question then becomes whether there's actually a derivative embedded in there. Now, what is a derivative? Let me tell you. If you want to have a debate about derivatives, come to an IFRS technical discussion internal at BDO, because what are derivatives? They're these conceptual issues that exist in accounting, but the really basic principle is this. A derivative is something that the value changes based on some sort of underlying. That's the definition in the accounting standard. But really, if you want to think about it this way, it's really when the value changes in relation to some sort of risk that is being managed. It's often pricing risk or market risk or foreign exchange risk or interest rate risk. Those sorts of risks are generally derivatives because their value changes in response to an underlying that's not the equity of the entity. So I had one the other day. It was really kind of interesting because we have a US private equity company. They're investing in Australia. The Australian entity is obviously got functional currency of Australian dollars because that's what they report their financials in. They do business in Australia in Australian dollars. But the US private equity firm has given them US dollars. And when it comes to repaying the US dollars, the amount they pay is being driven by the US currency, not the Australian currency. So although there's a basic loan there, the fact that there's a currency differential in the amount of repayment is the derivative, because it's actually protecting the investor based on foreign currency risk as opposed to equity risk. And that is a derivative. It's essentially the values changing for some sort of market underlying that the investor is trying to protect themselves for, foreign currency risk in that case. Those are the derivatives. Those derivatives are the ones that become problematic in the accounting. In addition to having a liability, you can also have a derivative liability. And a derivative liability is the thing whose value changes when that underlying changes, whether it be an interest rate or foreign exchange rate or something underlying is driving the return to the investor. If you really want to actually boil this down to something really simplistic, I'd say this is the easiest way to do it. If the investor in a convertible note gets a return that the other shareholders are not entitled to because of some type of variable like foreign exchange or interest, that's a derivative. And that derivative has to be separately accounted for from the loan. And that derivative obviously has a value that changes as the underlying variable change. So if foreign currency movements or interest rate movements go up or down on the market, the value that the investor gets back changes, and that feature is a derivative liability. It requires to be separately accounted for, separately valued, and revalued at each reporting date, and that's what introduces your volatility to earnings. Now, it's quite complex. There's a lot going on there. So we're going to get into some examples as we move through move through this today. This is an interesting one, and this is the slide I think is very good to use in the negotiation when you're negotiating these instruments, because these are the things that kill you in the accounting down the line. The first thing is when you're negotiating a convertible note, on the left-hand side at the top, is whether you've got equity or liability. The fact that you might have to issue shares at the end is almost, well, it is irrelevant. It's got to do whether you've actually got to settle the liability. So if the investor or the equity holder, the person who's bought into the entity and holds the convertible notes, if they get to decide whether to be repaid in cash or in shares, you have a liability, no doubt. And the reason for that is because the entity cannot avoid paying cash back. He might think he's going to issue shares, but the fact that he can't avoid paying the cash is the distinguishing feature between a liability and an equity. And that kind of bleeds into the next point on the right-hand side at the top, which is the distinction and the accounting for convertible notes is not driven by what you think is going to happen. It's driven by the rights of the various parties in the agreement. This is very much driven by rights and obligations and who holds those rights and who can obligate the entity to go down a certain path. Very, very seldom that I've found features in a contract that actually aren't genuine or don't actually have some sort of implication for the accounting. And I just want to actually put another example on the table. We often see that lawyers will build into contracts things like if there's a liquidation, certain things have to happen. Those features are relevant to the accounting. Don't walk past them. So I'll give an example of one we see very often. You've got a scenario where there's a loan which has to be repaid if the holder chooses the cash, or there can be equity issued if the holder chooses the shares. But if there's a liquidation event, or if there's an IPO event, or some type of fundraising thing, certain things happen at that point which give the holder additional rights. Those rights can't be avoided if those events happen. They can't be avoided. And one of the key ones is liquidation and winding down. Because if the event is not in the control of the entity and cannot actually be avoided by the company, then that is relevant to the accounting. And it's often things like IPOs, it's often things like raising new financing from other investors, and in even just liquidation and winding down. Those events, if they can't be avoided by the company and they give the holder additional rights, those additional rights are relevant. And if those additional rights mean that the entity can't avoid paying the cash, you have a liability immediately, and then off you go. So that's really, really important in the accounting. Down at the bottom, I'm not really going to get into puttable financial instruments. We don't have this sort of time on our side today, so I'll kind of leave that to the end, or leave that to the side for now. But the last one at the bottom just reiterates the fact that an entity has no obligation to pay cash does not mean that you don't have a financial liability. And I'll give you a straight example of this one. If you have an entity that actually has a scenario where they raise a liability, or they have a liability because they might have to pay the cash back, or they may have to settle the liability in shares equal to the amount of the loan, that is also a liability. And in that scenario, the reason why it's a liability is because the entity is actually using its shares as cash. It's using its shares to settle its obligation. So basic example, $1 million loan, which means if you either pay the cash back or you pay the holder shares equal to the $1 million, it's a liability. All you're doing in that case is using the shares as currency. And in that scenario, you still have a liability. So the fact that there may not ever be a cash settlement doesn't mean you don't have a liability. Now, I've been harping on that for most of today, because as much as the derivative liabilities are problematic, it's actually the liability versus equity classification that in practice is most hard for our clients to understand. Most directors or shareholders or companies still think that if equity might be issued, they have equity when they account for these, and that is not the case. If you've got an obligation to settle, and that obligation is either because you can't avoid the cash or because you're using the shares as currency to settle the loan, that is a liability, no doubt. And you won't have, I can almost guarantee there'll be no equity in the accounting in that scenario. So please don't get caught out by that one. I think that those are probably the key points to make under there. So going through this, the analysis of the terms of the financial instruments. Now, this is important because it's got nothing to do really with what you think is going to happen. It's got to do with the rights and obligations of the various parties in the agreement. That's where you start. And the various components of these are analyzed separately. And what we mean by that are the various features that essentially drive their own accounting or have their own risk exposure. The liability component of any convertible note, the straight loan with its effective interest rate, is generally always a loan. Debit, bank, credit liability, and then you account for interest on an ongoing basis on an effective interest rate. But the components that have different features, like, for example, foreign currency or interest rate type derivatives, those need to be separately accounted for and analyzed separately in the accounting. Now, I'll leave the analysis on how that works to Aletta and Ashley, because they've got some great examples coming up. But essentially, these three boxes are the three types of accounting we often see. The basic convertible note has liability and equity. That's your preference share we all learn at university. We don't see that much anymore. The ones we see are the one in the middle and the one on the right, which is hybrid financial instruments. And that means you've actually just got a liability and a derivative liability feature. And the derivative liability are the standalone features that really have no bearing to the loan. Those are the features that no other shareholder has, that are driven in value by some sort of underlying variable, a foreign currency variable, an interest rate variable, or even weighted average share prices in the last 5 days. Those are all variables that other shareholders can't share in. Those are derivative liability features. And basically what happens there is you have a liability accounted for as a normal loan, and the derivative liability is fair valued. The last one on the other side is just a straight liability. It might be structured as a convertible note, and it might have the possibility of issues of shares at the end, but the straight liability is simply you're either going to pay cash or you're going to settle shares to equal the cash in order to settle the obligation. That's a straight liability. And I think the next one actually has some examples which we'll do for you to kind of show you this. Yes, Aletta.
My question to you, and maybe if you can articulate to everybody, is so if the whole thing is a hybrid financial liability, it's a liability. Why do I have to further separate it out? You know, a lot of people say it's just a liability, let's move on. But in that middle one, if I've got a liability and a derivative liability, why is it important to keep them separate?
It's interesting because the derivative feature actually gives the holder a better return over and above the shareholder, and very often that can go up and up and up and up in value depending on how much upside the holder has secured himself. And that's the important thing here is when companies are giving away the bank during the negotiations, they're really desperate for the funds. They often give the holder features that give them not only upside, but upside that's unlimited. And that upside can grow and grow and grow in value. And what it means is when it comes time to settle, it's not just paying back the loan element. It's actually also issuing shares to a value that has grown so exponentially in size because all the upside is in the hand of the holders. That's the derivative feature. And that's really why you need to account for it separately, because you need to reflect the fact that when that value starts to increase or decrease if it goes the other way, but it's very often about increasing, you're actually giving so much more away to this group of investors that the existing shareholders, their rights to receive return on this is actually being eroded away by the fact that this derivative liability is building in value. I mean, I have seen scenarios, and I'm sure you have a letter as well, is where the derivative liability gave so much back to the investors that they literally took the company over, that the owners lost control. And that is what's being reflected in the derivative liability. So a common example of you issue as many shares as need be to settle the value of that feature. That feature grew so big in one scenario, it literally handed control of the company over to the investors. And that's a sneaky one where the investors are coming in through the negotiation and they can see that you've got a great idea. The great idea is almost there. You've almost reached the end of the development of it. You just need some bridging finance for perhaps maybe the next 6 months or a year. But they can see that if they take and take and take from you, you are so desperate for the funds as an owner, you give away the bank. That's what I mean by give away the bank. That when you actually issue shares to settle the loan, you're not just settling the loan anymore. What you're doing is you're giving them as many shares as returns the favor to them, loan plus variable return in the form of some sort of equity feature that is more than the existing shareholders are entitled to, and you suddenly hand your company away. They get control, because when you settle that derivative, you have to issue so much equity that you've literally diluted the existing shareholders' value down to nothing. That's what we mean by derivative liability feature. Does that answer your question, Aletta? I think.
Yeah, thank you very much. And I suppose I was also thinking, a lot of people think if it's a liability, the accounting treatment is the same, but the liability is potentially at amortized cost, where this derivative, because the value increases constantly, is at fair value. And
That's right.
that change in fair value goes through P&L over time.
That's right.
So, to put it just together doesn't get to the same outcome.
No. And it's going through profit and loss, because ultimately profit and loss is a reflection of return to ordinary shareholders, and those ordinary shareholders being the ones that are currently ordinary shareholders. So convertible note often is you haven't issued the shares yet, but you will, or you may issue the shares in the future. The reason why the value and the adjustments are going through profit and loss is because that value is already eroding the existing shareholders' return, and that's why we are valuing it. And that's what you're doing with an embedded feature. Just quickly, two last examples, because then we can hand over to Aletta and Ashley. So three examples of compound instrument. An example is a convertible note of a compound instrument, which gives the option to the holder to receive the principal repayment or to convert the note into a fixed number of shares. Now, I haven't really referred to the fixed for fixed thing yet, but let's actually just deal with that. If you give a convertible note where what's going to happen at the end is either you pay the cash or you issue a fixed number of determined shares, so the number of shares is already determined, fixed at the outset, that scenario probably does have an equity component. The reason for that is because the options are you either settle the cash, settle the loan, or you issue a fixed number of shares, which doesn't give upside return to the holder. What's actually happening there is they can only ever get a fixed number of shares. That's an equity component, because ultimately what you're doing is you've promised to issue a fixed number of shares for cash. So in that scenario, there is an equity component, because there's no value driver that's increasing, or decreasing and decreasing. The only options in that scenario are pay the cash, pay the loan, or issue a fixed determinable amount of shares at the beginning. The only option there is that the holder either is going to get the cash to settle the loan, or is going to get a fixed number of equity. It doesn't matter how much the value of the shares go up at that point, they're still going to get a fixed number of equity. That does have an equity component, so-called fixed for fixed shares. But if that equity component is not fixed to a fixed number of shares, that's when we get things like these embedded derivative liabilities, where as the value of the shares increase or decrease, the holder gets more and more and more. A hybrid financial instrument, this is a very, very interesting one. An example is a convertible note that gives an option to the holder to receive the principal and interest, let's say, but also the holder can convert it into the issuer's shares based on a weighted average price of shares for a specified number of days before maturity. What's happening here is the entity is actually using their shares as currency. So they are settling the shares as currency, but the conversion price is based on a weighted average price of the shares, like the weighted average price of the shares on the market, let's say 5 days before maturity. That's the convertible, that's an embedded derivative, because the value is being driven by the price of the shares, the underlying price value. And then in a liability, I think I used this one already, where you got a straight liability where the debt will only be repaid on instrument in cash. Well, in that scenario, you got a straight liability. Or if you're actually going to use your shares to settle the liability, where the number of shares that is being issued is equal to the principal of the loan, that's still all a liability, because in that scenario they're only getting the value of their loan back. Even though they might be settled in shares, it's still all being issued in the value of what's the face value of the liability. Now, I think at this point it's probably murkier than mud, so Aletta is going to introduce you to a very interesting tool that may help make this a bit more simpler to understand.
Thank you. Thank you very much, Kevin. So I think to maybe just take a step back, what's happening here is organizations are looking for cash and they receive cash. They say debit cash. And the question is, what do we credit? Do we credit a liability? Do we credit equity? Do we credit both? And once we've done that, once you've got your liability or your liability and equity or your equity, what do you do after that? How do we continue to measure that liability? Now, this is a very important decision for our clients because clients are saying, yes, I've got my cash, but when I look at my balance sheet, usually we would like to credit equity. Because I've got another asset, the balance sheet is looking better, I've got more money in the bank. If I get cash, debit cash, and credit a liability on a net position, there's no real change in my balance sheet. So a lot of people are trying to get cash in the door and try and credit equity to improve the balance sheet, to actually increase equity. However, we find that, a lot of entities, when they issue these notes, when they get the cash, it's actually, I cannot avoid to repay this cash sometime in future. I've got this money, I can use it, but at some stage I have to repay it, and therefore I've got a liability. So it's a big decision. If you think of the face of your balance sheet, what do we do with that credit side? Now, on convertible notes, which is I think the best example of it, but it's more than just convertible notes. We have come up, or at BDO Global, we've come up with a decision tree, which is it looks very complicated, but this is an amazing decision tree developed by our global partners to just focus our thinking. There are so many things to think about. And I'm always amazed. I was not part of the development with this, so I can really objectively say I was so amazed that somebody could put a logical order to it. And we've stress tested it with so many instruments. So it's a really beautiful diagram. And I think the key thing that we'll do today is that Ashley is actually going to apply this diagram to 3 different examples. Now, in our publication, we've applied this diagram to a number of examples. But she's going to apply to 3 in particular and show you how the thinking should be applied and how this works. Now, what's important on this diagram or the flow chart or the decision tree is that you will apply it to different components separately. Sorry, before I go there, I should just step back. So it has been designed to enable an analysis of financial instruments by individual component parts. All right, so we look at the individual parts separately to identify whether individual parts would be a liability or whether it would be equity. So that's important. You cannot apply this diagram just to the whole note and off you go. You have to look at the different parts separately. And that's why what Kevin has discussed has been so important, to identify the different parts. I think when you look at this, the very first question, and a very important question, is there a contractual obligation that the issuer cannot avoid, as Kevin flagged, cannot avoid, to pay cash or to exchange financial assets or liabilities under conditions that are potentially unfavorable? So really it's the primary condition that we look at to determine if this financial instrument is a liability. So can we avoid paying this, whether in cash or other financial instruments? So it's the threshold question, absolutely. If you say, I cannot avoid it, then it means I've got a contractual obligation to pay cash or a financial asset. I cannot avoid it. We will consider whether there's an exception under IAS 32, so the puttable instruments. It's not a derivative, and therefore, usually in this case, we'll end up with a liability. However, if you say, hang on, is there a contractual obligation that the issuer cannot avoid? And we say no, then obviously we can avoid it. The double negatives drive me insane. And we go to question 5. And then in question 5, the question is, will or may it be settled in the entity's own equity instruments? So if the answer to this, but I have to keep on clicking here, if the answer to this particular question is no, the instrument would be classified as equity. An example of this would be where the instrument is the entity's own shares or the entity's own ordinary shares. Now, the entity does not have a contractual obligation to pay cash to settle these instruments, and the instrument will also not be settled in the entity's own equity instrument. So that's the best example of a straight equity. The other is if we say yes to question 5, this means we have to go on to question 6 and a number of other aspects. And if you go to question 6, a key issue is this a derivative? And we've put there the definition of a derivative. So the value changes in response to something else. So the value changes because there's a change in exchange rate. The value changes because there's a change in an interest rate. The value changes, there's a change in the price of gold or another commodity. Initially, there's not a lot of investment required, so it's usually quite high risk because you can get into this without spending a lot of money, and it will be settled at a future date. So if you go to question 6 on the next slide, is it a derivative? If you say yes, you go to question 8, will the derivative be settled only by the entity exchanging a fixed amount of cash or another financial instrument for a fixed number of its own equity instruments? So that fixed to fix that Kevin talked about. If you say yes, you go to question 9. If you say no, you've got a derivative liability. So you can see there's so many questions flowing about, interacting with each other, that the best way is really to look at practical examples to see how this plays out. Because if you go back to question 6, is this a derivative? If you say no, it's not a derivative, okay. Does it include any contractual obligation for the issuer to deliver a variable number of its own equity instruments? So, in that instance, yes, then it's a liability. And that's what Kevin again talked about. It's because you're using your own equity instruments to settle this liability, similar to cash. If you say no, again, you get to the question, if the issuer has the option to deliver either cash or another financial asset or its own shares, does the value of these shares substantially exceed the value of the cash, other financial asset? And that would be our next consideration. So I think what's important here, I think I can't overemphasize, this diagram is trying to take you to a logical journey through an extremely complex standard. And I think, Ashley, maybe the best way to do it is actually to look at the case studies. We've included some slides here on, what are some examples where a financial instrument can be a liability. So I've put in a number of examples and an explanation. So why would this often be a liability? We've also put in some examples, where a financial instrument can be a derivative liability. And we've put in situations where it could be equity. So there's a number of examples for you to think through. I'm just conscious of time. It's 11:45 and I want to get to the case studies. So Ashley, there's examples for people to look at. There are commonly observed features for people to think about. I want to get to some case studies. So I'll hand over to Ashley to look at case study 1. And the reason I want to do this is I know that Kevin and I have been talking very high level theoretical, and it all becomes a bit mushy in my head, Kevin's head, everybody's head. And the way to maybe ground it is to look at a specific convertible note. Ashley, so over to you.
All right, thanks, Aletta. All right, so we've put together a few case studies. I'll try and get through as many as I can, but they're in your participant pack. So if you just have those open as we're going through, so you can have a look at the background facts while we're doing the polling questions. So this first case study, we're looking at instruments with a down round feature. So down round feature is an anti-dilution provision which adjusts conversion ratios if there's an issue of shares at a price that is less than the conversion price. So the key concept we're looking at here is whether bringing in these down round features means that the fix for fix criteria is failed. So to look at this case study, we've got two different instruments, a convertible note and the preference shares. So both have very similar terms, annual coupon at 10% for the con note, and then the 10% non-cumulative preference dividend for the preference share. On the next slide, we've got the repayment terms. So the con note is repayable in cash unless it's converted into equity prior to maturity. The conversion, the terms of the conversion is that it's convertible at any point at the option of the holder, and the conversion is at 500 currency units per share. And then also the interest accrued is to be paid in cash. And then the introduction of the down round feature. So we've got a feature where if ordinary shares are issued during the term of the note for less than the 500 currency units per share, then the conversion price is reset to the new share issue price. So our first polling question is in relation to the convertible note and how would this be classified? So we've got three options. Option A, you split out the annual coupon and principal repayment, and that would be a liability. And then the conversion feature would be equity. Option B, again, annual coupon and principal repayment liability. But here we're saying, would you split out the conversion feature and the down round feature? And is the conversion feature equity and the down round feature a derivative liability? And then option C, again, annual coupon and principal repayment liability, and whether the conversion feature and the down round feature are derivative liabilities. So if we run the poll question, I'll give you a little bit of time to respond to that.
Ashley, and I think this is a really good example on the concept that you will apply that diagram to each part. The diagram cannot be applied to everything together. So when you answer those questions, look at the component parts.
Okay, great. Thanks, Aletta. So just a reminder, if you haven't got your packs open, option A was to say that the conversion feature is equity. Option B was the conversion feature is equity and the down round feature is a derivative liability. And option C is both the conversion feature and down round feature are derivative liability. And as Kevin went through, the key concepts here is looking at, is there a derivative, and does the introduction of the down round feature mean that we've breached the fix for fix criteria?
Ashley, we've got a large number of people have actually voted. I think we might close it and then we can share what people were thinking. And you'll see it is very much, split across. Everybody's got a slightly different view maybe on it.
Yes, which is typical to
Yeah,
yes, what we all see when we're trying to nut through these arrangements.
absolutely.
Oh, so thank you. So the answer for this case study is option C. So if we go on to the next slide, obviously the annual coupon and principal repayment is a liability because there is a contractual obligation to deliver cash that we cannot avoid. So that first component is the liability, and then looking at the conversion feature and the down round feature. So because these two features are linked, meaning that the exercise of one results in the lapse of the other, you need to analyze these two together. So whereas from the background facts, it looked obvious that the conversion feature on its own would meet the fix for fix and therefore be equity. Because of the link of this down round feature, you have to look at them together, and it pushes it into a derivative liability. So applying this to the diagram that Aletta went through, so we'll just skip over this one, Aletta, that's just the annual coupon, which was obviously the liability. So looking at the conversion feature with the down round clause, so the relevant question here, question 6, it is a derivative, and then that puts you through to question 8. So will it be settled only by exchanging a fixed amount of cash or for a fixed number of its own equity instruments? And because of the down round feature, the potential number of shares to be issued is variable. So this means that the conversion ratio is not fixed, and so the answer to question 8 is no, and we end up with a derivative liability that then needs to be separated from the host liability, which will be recognised at amortised cost, and the derivative liability is at fair value going forward. So hopefully that clears a bit of the confusion up. The next question we won't go through, but this was the preference shares. So they very similar terms to the con note, except that these were non-redeemable preference shares, so there was no cash repayment required. So you can work through this one on your own, but the essence is that for the preference shares, you have two approaches that could be applied. So either the entire preference share is classified as equity, or the preference share is classified as equity and the embedded derivative is accounted for separately. So that's an accounting policy choice. But the key point here is to understand, why is there a difference between the classification of the conversion feature when the terms were almost exactly the same? And the answer is because of the different nature of the host instrument. So because the non-redeemable preference share is equity, that can change the classification of the conversion feature. Okay, so the key takeaways from this case study is that the presence of a down round clause can cause a conversion feature to fail fixed for fixed, which it otherwise might have met. And even if the conversion terms are similar, a change in the characteristics of the host instrument can change the classification of the conversion feature. So critical things to look out for: very similar instruments can have different accounting impacts. Okay, so case study 2, this is where we're looking at contingently convertible notes. So the key concept with these notes is one of the points that Kevin touched on is to look at what is within the control of the entity. So if the contingent event is controlled by the entity, that you may end up with an equity classification, but if the entity cannot control the event, then you end up with the liability. So for this case study, we've got GTL issuing contingently convertible notes prior to their IPO. So this is to expand their operations. And And this is something that we are seeing a lot of at the moment with the recent IPO activity. And what we're seeing is companies that are going through the IPO process who have these contingently convertible notes. What we're seeing is if they're relying on the net asset position for their listing requirements, what they previously may have classified as equity may end up being a liability, and then they end up failing the net asset test. So it can have huge impacts on your listing process. And to reinforce what Kevin was saying earlier, that this is like in these types of situations, getting the accounting understood early is critical. So for this one, we've got 3 different convertible notes, all with the same terms in terms of the amount, 3-year maturity, 10% coupon, and all are repayable in cash on maturity unless converted. On the next slide, we've got the terms of conversion. So for convertible note A, if GTL initiates the process for an IPO before maturity, the note converts into 1,000 shares. So if that event happens, it automatically converts into a fixed number of shares. Convertible note B, the conversion term is that if GTL successfully completes an IPO, then the note converts into 800 shares. And then convertible note C is, again, if GTL successfully completes the IPO, the con note converts into shares at a conversion price that will be at a 20% discount to the IPO offer price. So the polling question we have here, so firstly looking at convertible note A is how would this be classified? Is that option A, the principal repayment is a liability and the conversion feature equity? Option B, principal repayment liability, conversion feature derivative liability, or option C, the entire instrument is equity. So just remember convertible note A, so we're looking at, is the conversion event in the control of the company? And the convertible note A conversion event is if GTL initiates the process for an IPO. How are we going with the poll, Aletta?
Ashley, the poll is well. I think we've got around 50% of people voted already, so that's fantastic. Thank you for voting. I'll close that and we'll share what people are thinking.
Oh, good. So it's good to see we have a spread again across the 3 different responses. And I think everyone was paying attention to Kevin at the start, where it's very rare to see that these instruments be classified as equity. But for this instance, we do have that rare situation where this instrument is equity. So the answer to this one is option C. And the reason for that is because the contingent event is initiating the IPO process. So just starting the process that's within the control of the company. So the entity can avoid delivering cash because they can just initiate the process of the IPO prior to the maturity of the note. So for that situation, if we go on to the next slide, Aletta. So we just note here that it's generally not observed in practice, as investors would normally prefer to have shares in a listed entity. However, for this case, the conversion terms were slightly more favourable, so the investors may agree in this situation to such a conversion feature. And I think the slides have frozen. We're still on the poll.
Oh dear. I have closed it, Ashley, so I don't know why it's doing that. Let's see.
Unless it's just on my end.
No, you are right. I've just checked, but I have closed it. I don't know how to. Why doesn't it stuck? Ashley, for some reason it's stuck, which is really weird.
I'll just,
I think I'm going to stop sharing and then I'll start sharing again. Maybe that will work. All right.
Okay. I'll just keep talking through this concept. So when we're looking at the diagram, hopefully everyone has the decision tree in front of them. So for convertible note A, the background facts were it automatically converts into a fixed number of shares on initiation of the IPO. So question 1, is there a contractual obligation that the issuer cannot avoid to pay cash? And the answer here is no, because like I said before, the entity controls the convertible event. So we move on to question 5, and yes, it may be settled in the entity's own equity instruments. It's not a derivative, and there's no contractual obligation to deliver a variable number of the equity instruments, and so we end up with equity. Now, if we look to
the slide should be back now.
okay.
Is that good?
Yep.
Yeah.
Yes.
Beautiful.
Good,
so you're going to 2C or 2B?
2B.
Oh, sorry. I think I went too fast.
That's okay.
Because I was trying to catch up with you.
All right, so 2B, we're looking at Convertible Note B, and the conversion terms for this one was that the note converts on successful completion of an IPO. So again, the key concept is looking at, does the entity control whether the IPO is successfully completed prior to maturity of the note? And the polling question here, so Convertible Note B, with the principal repayment be liability and the conversion feature equity, that's option A. Option B, principal repayment is liability and conversion feature is liability. Or option C, the principal repayment is liability and the conversion feature is a derivative liability.
I think, Ashley, we might just discuss the solutions in the interest of time.
Yes, good idea. Okay, so for Convertible Note B, we've got the principal repayment is the liability and the conversion feature is equity. So the principal repayment, obviously, they have the obligation to pay cash, so that's similar to the to question 1 we went through earlier, so I won't go through that. But if we just walk through the conversion feature on the next slide, so here we're looking at, is there a contractual obligation to avoid paying cash? Sorry, is there a contract that they cannot avoid? And that's no. It may be settled in equity. So question 5 is yes. And then the difference here, is it a derivative? So question 6 for this note, yes, it is a derivative. Question 8, will the derivative be settled only by the entity exchanging a fixed amount of cash for a fixed number of its own equity instruments? So looking at the fixed for fixed criteria, and in this instance, it does meet that because there's a fixed number of shares, being the 800 shares that will be issued on settlement of the note. Question 9 is not applicable here because the issuer doesn't have any options, and so in this scenario, the conversion feature would end up being equity. So again, you look at the host liability first, and then the conversion is the equity, which is the residual. And then if we just quickly go through Convertible Note C, so this one differs to Convertible Note B in that the conversion price is based on the 20% discount to the IPO price. So walking through so this one would be classified the principal repayment as a liability, and the conversion feature is a derivative liability, so option B here. And then if we just go through the decision tree, again, question 8 is the critical question here, and does it meet the fixed for fixed criteria, which is no, because the number of shares varies depending on what the IPO price is at the time of settlement. So here, the difference between Note C and B is that we have a derivative liability rather than equity, and this is at fair value. So going forward, we could have quite large financing costs and fair value movements on your balance sheet. So the key takeaways, so for contingently convertible notes, an assessment is required of whether the contingency is within the control of the issuer or the holder, and that drives the classification, so that's the critical element to understand. A small change in the terms of the contingent conversion can change the classification of the instrument, and a derivative is classified as a derivative liability unless it meets the fixed for fixed criteria, regardless of whether the issuer can avoid settling the derivative. And then the final case study, I'll just leave that for you to go through in your own time, but this is looking at anti-dilution features. So this is where if there's a rights issue during the term of the note, the conversion price is reset, and depending on the clause and how the conversion price is adjusted can change the classification of your instrument. So if we just skip through just to this next slide, yes, this one. So for convertible notes with anti-dilution features, so if the key point for these ones is to look at the relative rights of the equity holders and the note holders immediately before and immediately after the adjusting event. So if those rights are maintained, then even though it seems like fixed for fixed would be failed, because you're maintaining the rights of both shareholders and the note holders, then you could actually have an equity classification even if these terms are in the contracts. So the key points to note on the next slide, Aletta. So just to point out that the adjustment calculation that we've included in this case study is just one of the ways in which the rights can be maintained, so there can be different formulas and still achieve the same outcome. And the key point is whether the anti-dilution adjustment maintains the relative rights of the option holder and the equity shareholders. So to summarise, a very quick run through of the case studies, but the summary for this whole session is key things to look out for when you're entering into these arrangements is, does the instrument have a down round feature? What is the currency of the instrument and whether it's the same as the functional currency of the entity? Does the instrument have a derivative? If there's contingently convertible instruments, is the triggering event within the control of the issuer or the holder? What is the impact of any anti-dilution features? And are the contingent settlement terms genuine? So that was a very quick fly through of some examples. If you want to work through any more in detail, you have the information in your packs, as well as the BDO Global publication, which really explains a lot of the different scenarios that you can look to. So I'll hand back to you, Aletta.
Thank you very much, Ashley. I think today's session was critically important because convertible notes are everywhere at the moment. And as a lot of organizations are looking for additional cash post-COVID or looking for money to grow and to pursue an IPO, this is happening more and more. So we wanted to just put it on your radar. There's so much complexity here, absolutely impossible to cover. Fantastic document that you can read. Ashley, thank you very much for working through the case studies just to give people an idea on the thought process, and how the flow chart applies. And I really think that Kevin did a really good overview of some of the things to think about and what he's seen in practice. I know he's had a lot of clients in this space. So thank you very much for joining us. If you encounter convertible notes, please contact us. They're not simple. They're very easy to get wrong. And as I said earlier, we consult with each other as well because there's so many things to think about. We're always concerned that we're missing something or maybe putting too much emphasis on a certain part. It's important to look at the whole agreement because one little obscure sentence can throw the whole analysis out. Obviously, if you need any assistance for us to look at convertible notes before the auditors arrive or before you sign the agreement, please reach out. If you want us to do an IFRS health check on your financials, if you want to convert to general purpose financials, or if you're looking at simplified disclosures under AASB 1060 and you're looking for a tool, please contact us. We're also running virtual workshops where the pace is much slower. We've got longer time, more case studies. So if you want to register for any of those, please feel free. And by the way, if we've already run the session and there's a recording, you can also buy a recording. I'm still speaking to clients about lease accounting, especially on this journey to general purpose financials. Do we have AASB 16 under control? And then I think the key thing, if you've got any questions, please reach out to Ashley in Perth or Kevin in Sydney, Clark in Brisbane, Lynn in Adelaide, or Melbourne or other locations. Please feel free to reach out to me directly. We'll speak again next month. Thank you very much. We wish you all the best for the 30 June 2020 reporting season, which I know is very busy. A year ago, we didn't think we'll be doing reporting season in lockdown again. But in Melbourne, Sydney, and Adelaide, that's definitely reality. Here we go again. So please stay safe, take care, and we'll speak soon. Thank you, Ashley.
Thanks, Aletta, and thanks everyone. Stay safe.